Hey, how you doing, everyone? Tom here from Park Avenue Trading. I want to bid you a good hello. For those of you that know me, hello. For those of you that don't know me, I'm a retired chief forex trader with over 30 plus years experience in this wonderful vocation of trading forex. So in this video today, I want to talk about a couple of things that I think that are really important. I'm going to basically talk about what the heck has been going on with the markets, and these market movements. Really, we've been seeing yearly movements in like a matter of a couple of days. Things that usually take a year to accumulate and to boom throw out on us, they're really happening just in a couple of days. It's really insane. So please, if you like what you see, like and subscribe to the video. Don't forget to ring the bell so you can always see what I got on my mind and what I'm trying to convey to you guys. So without further ado, let's talk about what's been happening over the last, I don't know, 10 days or so. Now, in complete transparency, I have to say that I had taken a holiday and I missed a big portion of the sterling yen move down. Not so much, but it was really dollar yen that ruled this thing. And as you could see, dollar yen was the one that was the big player, the big mover. So, because if you look at sterling dollar, hasn't nearly had as big as a movement as the dollar yen itself. So the first part of this video is I'm going to take you through how fundamentals actually are always playing in the background, and I'm going to take you through a little history, and it's just going to be something that you get that you could take to the cigar shop with you and sound like hey, this guy really knows something about what's going on in the markets. So with that said, let me just pause this and let me get to a Venn diagram that I actually drew by hand so we could talk about these things. Okay, so what I did here really horribly was attempt to do one of those Venn diagrams where basically those center of the circles intersect and you have what's the relationship between all of them. It's a very, very, very low form of actually putting this together, but it's something to look at. Okay, when we have stocks, stocks are basically run on fundamentals of a company. They're also run on the market share of a company, how well they're doing, of course, what their price earnings ratio shares are, and all that other stuff that do stocks. They're definitely certificates ownership. They are definitely affected by what the interest rate is in the economy. They're risky. Just like Forex is risky, but stocks are risky as well. Don't know if they're going to go to zero. Company could sound great. Next thing you know, craps right out, goes to zero. Trading is definitely run by emotions, just like in Forex. And, you could definitely use technical analysis with fundamental analysis. So we have in the middle fundamental analysis. Forex, this is Forex. Interest rates are also part, of which way a currency is moving. Emotions and technical analysis. Then we got the U.S. bonds. Those are fundamentals of the economy itself. They're U.S. government owned. Interest rates, they actually determine interest rates. The Fed does. So therefore, it affects all the government bonds that are out there. And this is what we're going to touch on in a second, right after this, because it was really, really important to talk about what happened with the Federal Reserve Bank. Yield search, is people that are really getting into bonds are looking for yield. They're not looking so much for risk. They're looking for a way to make yield. The rates based on government debt. So in other words, Moody's rates the U.S. government, and it hasn't been too great lately, because we've done some shady things, and I have to say you have to be really cautious, or we have to be really cautious on what we're doing. And we can get into that in another video, but there's less emotions involved. Definitely yield curve analysis, and of course technical analysis. So here's where they all intersect: interest rates, emotions, technical analysis, and of course fundamental analysis. Okay, so let's get back onto what the heck's been happening in the first part of the story that I'd like to tell you and have you guys kind of understand how fundamental analysis playing in the background. Fundamental analysis is like always running in the background. I mean, I'm a technical trader, but it had to be really stupid not to try to pay attention to fundamentals, because it's like fundamentals are like music at a dentist. You know, you hear it, but you're not really paying attention to it because your mind is on like other things, like, oh my gosh, is this root canal really going to hurt? Or so that thought is blaring in your mind like rock music, not like the music that's playing in the background. So let me get over to the chart, and we'll take it from there. Okay, so like I said on the last slide, fundamentals are always running in the background. Now, the problem with fundamentals is that you just don't know the tipping point, and that's where technical analysis actually helps you determine, you know, like, oh, the tipping point. Now, generally, you know, this is actually a daily chart, and the movements here were incredible. So obviously, oh, well, that was going down, right? Well, many times markets don't do that. You know, they test the bottom, and which they did right here. They actually did test this slightly and then came back up. Actually, I can go down to this level right here where there was congestion, and then there was the other push down. So what could we use to basically determine whether or not this is, you know, a major move or not? Well, I have something that I call trend reactionary levels, trend reactionary numbers. I can get into that at another time, but really what they are just measured movements. And generally, when one trend reactionary number breaks, the level breaks, it's signaling like that there's definitely, you know, something up here, and this could be, you know, a major type of move. So, but before that would be another video that we could talk about, and I can actually discuss, you know, what trend reactionary levels are and how you can get them. I give them out for free. I just don't teach how to do them. You know, they're definitely part of my system, and I give them out freely and for traders to use because they're great support and resistance levels. However, let's get on to the task at hand. So about, I don't know, I would have to think about a month ago, I read a story in the Financial Times, an article in the Financial Times, and it was talking about a huge Japanese agricultural bank that happened to be called Norichukin Bank. And Norichukin Bank was in trouble. It was in financial trouble. It needed liquidity. Now, the thing about Norichukin Bank is that they owned a tremendous amount of U.S. Treasuries. And before, I mean, the Treasury market itself, the U.S. Treasury market itself, has been in a bearish. The bonds have basically been going down because interest rates have been going up. Okay, so they owned interest rates at a lower price level. They were getting a yield on it, but they weren't getting the best yield. And really, they had to make a decision. So what they decided was, according to the article, what the article was alluding to was that they were going to sell a massive amount of U.S. Treasuries. And when you're a foreign bank and you're selling U.S. Treasuries, you're getting dollars in return for those Treasuries because they're priced in U.S. dollars. So what the bank needed to do was basically slowly unwind their U.S. Treasury position, sell their U.S. Treasuries, collect dollars for them. Then they needed to sell dollars and buy back the yen, bring the yen back home. Now we're talking a tremendous amount of U.S. dollars. So as you can see, the chart here, now here was the thing with fundamentals is I knew this story. I just didn't know exactly when it was going to happen. And I was talking to a friend of mine. I was saying, well, they could take this thing up to 170. You know, it'd be better for them, for the marketplace to actually push the marketplace up as high as they could get the price of dollar yen so they could sell and get the most amount for it. But obviously they didn't do that. They waited right to 160, 195, 162. So now if I go to a weekly chart, you know, it's a real interesting thing. I mean, of course, hindsight, you know, it's 2020, you know, but if we go to a weekly chart and we can look, we can see that the previous high recently is in 160.23. So the marketplace basically creeped up a little bit higher than 160.23. This was the first signal. When it went back through this top, this is the first signal, hey, maybe something's up here. We went through a previous top. That's a technical indication that marketplace is getting weak. As long as it does not rebound and take out the most recent top, this is basically showing a bearish condition, technically. Now, with the fundamentals playing in the background of Norichukin Bank needing to sell dollars and get yen, this played out perfectly to show you this scenario. Now, that was the first part of this thing, so let me mark Norochukin Bank off. The second part of this thing was a $20 trillion carry trade that's been going on since 1994. 1994. And the first person to alert traders of this was a gentleman by the name of Robert Rubin. He was a Treasury Secretary back for the Clinton administration in 1995. And basically, he warned the Japanese that by continuously keeping interest rates low, artificially low, they weren't going to spur their economy. Because his argument was that if you raised interest rates, people would then, oh shoot, I'm not going to get cheap money anymore. They'd run in and take investment to actually put back into the economy. That was his theory. Okay? Now, that was great fundamental analysis. Now I want you to look at this. It happened in 1995. If you were waiting for that to occur, you'd be bankrupted, I don't know, 40 times already. So it just goes to show you that fundamental analysis, although playing in the background, it needs a trigger. And that trigger is technical analysis. And then technical analysis tells you whether or not, you know, this is a real move, it's really a big move, it's a trend change move, or, you know, oh, it's just a natural fluctuation. Now I'm going to tell you, naturally fluctuations in the marketplace are about 6%. That's an extreme move. This has been 15%, 16%. So this is really extreme. So there's a trend change happening here. Okay, and all right, obviously, oh yeah, Tom, you're brilliant. You know, look at what happened. Well, here's the point. The point is no longer do not be playing the game of buying dollar yen on dips. Not yet. Look to sell dollar yen at resistance levels, right? With good stops, decent stops. I mean, don't lose too much. So I'll leave you with that. That's 2 points that I wanted to make in this video. I mean, I know it's kind of haphazard, you know. Just the main point was fundamentals are always playing in the background. As a technical trader, you got to always pay attention to them, and you need to know a little bit about history, and you also need to start reading in between the lines. If you read the Financial Times, Barron's, things like that, start trying to decipher things. So I look forward to seeing you in the next video. And please, if you like what you see, like, subscribe, don't forget to ring the bell. Go on over to Park Avenue Trading. Get yourself a free technical a book on technical system that you can actually trade and use, okay, to see if breakouts are going to be false or if they're going to continue. Look forward to seeing you soon. Cheers.